Okay, guys, changing gears, we're going to go to labor and inflation will help mortgage rates in 2024. That's a bold statement coming out the gate. Do you agree or disagree?
Well, I mean, if we're going off the fact that, unemployment claims went down, sure. But that was just for the week of September 2nd. So once again, I'm taking everything with a grain of salt. We haven't had enough data to show that. But I mean, sure, if you want to zoom in and base it off one fact, yeah.
Yeah, and this market's totally different. It used to be that when the traditional way was when inflation's going down, interest rates will actually go down with it. But nowadays, it's like you don't even understand what the data, because there's just so many other things that they're factoring in that we're kind of going in the opposite way.
Yeah.
That's crazy you bring that up, because like for me, seeing inflation go up and interest rates go up with it, I mean, that's just pretty normal to me. So to hear that, in my head, like a light bulb went off, like, what? That happens?
Yeah.
Yeah, it is kind of defining this whole new normal we've talked about before, which are we supposed to be getting used to this? And more we talk about this and see these kinds of things, it's like, yeah, I guess we're being primed and conditioned that this is what we should expect and this is what we should be used to in the market. Whether it's comfortable or uncomfortable isn't the question anymore. It's whether you are going to agree or disagree. I agree that labor and inflation will help mortgage rates, but because it will be painful. That's really the truth. It's going to be painful, and that pain in the economy is going to cause the Fed to have to start doing some sort of rate cuts in the future.
Absolutely.
So do you guys think that a stronger economy leads to higher inflation?
Well, there's a part of that. It's 100% correlated, yes, because when there's more money in the system, that money can afford things at the price that they're set at. When there's less money in the system, it sounds like there's scarcity in the system, but it's actually scarcity of goods that can drive prices up, but volume of goods that can drive prices down.
No, 100%. And the reason I ask is because if we see on paper, we're all still making money. On paper, everything's still going up. So therefore, I feel like once we get that taken care of, I think the labor needs to soften up a lot more to be able to bring down the rates as well. And then that's going to help with inflation as well, bringing it down. So I think until we're able to see more softening in the labor market, because jobs are still being produced, people are still not claiming as much in unemployment, but at the same time, it is going up slowly, but not as fast as we'd like to see it. And therefore, I feel like rates are still going to.
Well, you got to remember, everything's with the ripple effect. Right now, we're probably seeing the rate hike that happened last year, barely. So we still have ways to go to see that ripple effect of what's truly going to happen.
Well, Will, if that's the case and they do raise rates again in November, could you see that carrying over all the way into next year then?
Absolutely.
100%.
Yeah, I mean, there's a delayed onset to a lot of this stuff. And what's a little crazy is when I zoom back on the chart and I look at the last 18, 24 months versus comparatively the prior 10 years, this is a very steep increase of the Fed funds rate over a very short period of time, historically speaking. So to us, we've kind of been marching through it. Every 6 weeks to 8 weeks, they have their meeting and we go, okay, cool, they hike rates. Okay, but there's a point at which you have to go, okay, let's assess now what's happening because of that. And that takes time, to Memo's point. It could be 6 months, 8 months, 12 months. Certain sectors react faster. Again, to the point earlier in the show, some are directly affected by the Fed funds rate directly and some are indirectly, and those have different time onsets.
That's it. And everything's going to affect. Everything's tied into the economy. So it's going to affect one place and it's going to make another jobless claims worse or more. Who knows? It's just confusing right now. Confusing times for sure.
Yeah.
And I think that's why Uncle Powell just doesn't know what to do. And that's why they're saying he's kind of like in a catch-22. Do I raise rates too high right now, cause a possible recession, or do I just keep them and kind of see where we're at, engage next month or next Fed meeting where we're at?
Yeah. I mean, if you guys forgot, or I did not forget, I remembered that, he used the word some pain many meetings ago. And he's like, we are going to be in for some pain as we go through this and determine what is the right rate policy or right monetary policy in order to affect the change in the outcome we need. And that kind of never left me. But yeah, I mean, admitting that there is some pain is one thing. And then admitting also that some pain is the lesser of two evils also suggests that they know something else could be worse for our economy, but isn't, because they're doing what they're doing now instead of that. So that's a little bit interesting.
Well, if Jerome Powell's watching this, we definitely are feeling some pain.
Yeah. Uncle Powell.
Oh, Uncle Powell. Sorry.
Uncle Powell. Yeah.
Uncle Powell. And please allow us to get into it.
And they know that this is they know what this is doing for housing. I mean, we get economic reports for housing every month just as much as they do for jobs and for inflation and other things that measure. I mean, we get new building permits readings, we get existing home sale readings, we get new home sales readings, we get all the same stuff, and they get all that too. They see all that, and they, over a course of time, you chart where those things are making impacts, positive or negative, and then you have to make policy changes accordingly. But here's the thing: shelter being one of the most expensive cost components of people's lives, or the biggest in most everyone's cases,
Of course.
it does create a problem. I think this is going to be an issue because housing is under a lot of duress as an industry, but that puts it onto the renter if they're renting or the homeowner if they're owning. Sans the people we refinanced that at 3%, 2.5%, they're all fine. They're all good. Their job is the only thing they got to worry about. But
Yeah.
And they haven't been losing jobs right now.
Yeah, not at the rate that we need
not
to.
enough.
Yeah. And that's one of the things that I've been seeing with everything that comes out is that they're slowly conditioning us for what's happening next. So if you read between the lines, they're already telling us what's going to happen. We need to see more labor softening. Oh, what does that mean? More people need to get fired. Inflation needs to come down. What does that mean? More people need to get fired so they stop spending. So until we're able to control that, that's when we're going to start seeing actual facts when the Fed goes up to talk and say, hey, this can be expected, this can be expected. But as of right now, it's already like, I think this might happen. This might happen based off of this, but everything's based off of something. There's
I
no
like that
sureness.
word conditioning.
Yeah.
Yeah, I think there's going to be a loose correlation to jobless and the 10-year yield only because we are now at 10-year yield trading prices that are most recently seen in 2007. Here we go with a Wayback Machine reference to all the way 2007 is when we saw a 10-year yield at this rate. And now we're going to start seeing jobless happen. It's a loose correlation. They're not directly correlated, but I think there is a case to be made where those do have some relative reflection on what's actually happening in the technicals. So there's that.
Yeah.